Hello once again. Today in this video, I will share an easy strategy that will guarantee allow you to retire comfortably. However, before we begin, I'm pleased to share that this is the first time we will be organizing a hands-on workshop on the 24th of July at Phillip Capital's Raffles City office, level 6 presentation room from 7 p.m, of which I will be conducting a masterclass for those of you who want to learn the tools and framework I use to screen for good potential value stocks. This masterclass is for those of you who want to understand more about what value investing is about, and I will be teaching you the value investing framework using a hands-on approach by screening for potential quality undervalued Singapore listed stocks. You can start grabbing your tickets in the link on the video description section below. This course is worth $3,000, but I will be sharing with you my experience and framework all for free. So click in now to secure your tickets as seats are limited. Hello everyone, welcome back to SDA Club, the club for stock trading and analysis. This channel is dedicated to providing you with high quality tutorials, guides and insights that demystify the world of trading. Join us as we will share more trading secrets and valuable insights. To stay updated and to be the first to access these valuable resources, hit the subscribe button now. By subscribing, you're opening the door to a world of trading and maximizing your potential for success. Before we dive in, here's a quick disclaimer. The information in this video is for educational purposes only. It's not a call to buy or sell. In my previous webinar, I spoke about comparing the DCA strategy with stock picking, which is better. Today in this video, I will give you an overview of what I shared during my webinar. How many of you here know what is the magic number to retire comfortably in Singapore? Is it $500,000, 1 million, or more than 1 million? Do you know that the median wealth in Singapore is $134,000 US? And did you know that this is already higher than the world's median wealth per adult? Now, can you guess what the world's median wealth per adult is? 82% of the world's adults actually have a net worth below $100,000 US. However, why do Singaporeans still feel cost of living is forever increasing and we constantly still feel poor? This is because of material competition. Singapore is a materialistic society. Our home, our car, our next best holiday, and the list goes on. Can we still achieve financial freedom in Singapore? That is, to build liquid assets until a point you realize even if you do not work, you still can live a moderately comfortable lifestyle, debt-free. In today's masterclass, I will show you one way we could achieve this. That is, how you can make your money compound. As Einstein once said, compounding is the eighth wonder of the world. He who understands it, earns it. So, what is DCA? DCA stands for dollar cost averaging. It is an investment strategy where you regularly invest a fixed sum of money into a specific asset on a set schedule regardless of the asset price. The ultimate goal for DCA should be to reduce the need for timing the market and instead focusing on the mindset and approach. What are the pros and cons of DCA? The good thing about DCA is it is automated. There is no timing stress and it trains behavior. How about the cons? DCA does not guarantee profit or prevent losses. If you already had a lump sum to invest, then the funds sitting in your bank account will lose out on opportunity cost. If you invested in a bad class of assets, DCA will not help improve your returns. You would just be catching a falling knife. Now, let's look at what is stock picking. Like DCA, stock picking also comes with a disciplined, repeatable process. We use some guidelines to screen for potential stocks. Stock picking requires good prediction skills. You're essentially betting on the future of the company. This requires lots of experience and time in the market. Whether by looking at the price action, using charts, or analyzing the fundamentals of a company, the more time you spend on it, the better you become. By understanding how a particular stock runs its business, you can use it as a guide to reasonably predict its future. Successful stock picking requires a repeatable process. At minimum, investors should understand the company's business model. They should also decide before buying what would make them add, hold, trim, or sell. So, what are the benefits of stock picking? Like what the great investors of our lifetime, Warren Buffett and Charlie Munger, once put it. Diversification is protection against ignorance. They argued that spreading money too thin across dozens of companies dilutes returns. distracts from your best ideas, and assumes an investor lacks the deep knowledge required to evaluate a business. As you already know, both Warren Buffett and Charlie Munger dismissed diversification just by playing on their strength of concentrating on a few good businesses, that they became one of the world's richest men. But how many of us have such a skill set? So, let us compare the two approaches across time required, skills required, emotional pressure, diversification, expected volatility, and suitability. DCA tends to fit investors who value consistency, automation, and reduced timing stress, while stock picking tends to fit investors who have the time, temperament, and process to evaluate individual businesses. DCA helps you avoid bad timing decisions, while stock picking requires you to make better selection decisions. Here are the annualized returns if you invested using DCA from 1990 to 2026 in a broad-based index like the S&P 500. If you use DCA and invested into the S&P 500 since the 1990s, you would have captured an annualized return of roughly 10.6%. Because the market trends upward over time, consistent DCA builds solid, reliable wealth. While in stock picking, returns would vary wildly. A tiny fraction of stocks, like mega cap tech companies, drove the bulk of market returns. If you had successfully picked these winners, your returns could easily exceed 15 to 20% annually. Conversely, if you picked underperforming sectors or bankrupt companies, your portfolio could have suffered total losses. A good way to start to deploy the DCA strategy would be to use the Vanguard S&P 500 ETF, ticker code VOO, managed by the Vanguard Group. This ETF tracks the S&P 500, or the stock performance of the top 500 listed companies in the US. Deployed well over a long time frame, your funds should on average give you a return of 10% per year. I hope that you have learned something from this video. For more information on how you can optimize your portfolio and would like to seek advice on your current investment portfolio, speak to us by replying to the WhatsApp link in the comment section, and our team can provide a personal touch and talk to you about your investment plans. You can also join our Telegram community by scanning the QR code here should you wish to get quicker updates on the latest economic news, stock ideas, or find out about my next upcoming live webinars or physical workshops. See you in my next video. Goodbye.